Look at all the news out there right now. Ray Dalio fears something worse than a recession. Sell USA. Tariffs may be sparking a storm on Wall Street. Well, it sure is. Layoffs at a Mack truck plant. Layoffs affecting 350 people. More layoffs resulting in closing of a plant. If you're like me, you've been staring at your portfolio and asking the question, what do I even do now? With all the fear out there, I was wondering, are there any good companies out there trading at good prices? So I used AI to filter through hundreds of stocks to find ones that were worth a second look. I came up with 3, and the third one I can't stop thinking about. I'll show you the prompts, the picks, and the logic of how I got there. Let's go. First of all, when I say cheap, I don't mean buying a $5 stock or a $3 stock. I'm talking about buying a stock that's trading below what its intrinsic value is. What does that mean? Well, let's use a couple of examples. So imagine that you're driving down a cul-de-sac, your favorite cul-de-sac in your neighborhood, and there's a house that's $100,000 less than all the houses on the street. But as you drive by, you notice that the roof is falling apart. The grass is not green anymore. The house needs paint, but it's $100,000. But the work that you're gonna put in is gonna cost you $150,000. Now that's a cheap house. That's not an undervalued house. But imagine you're driving down the same street, and as you drive down, you notice another house that's $100,000 less than all the other houses on the street. The grass looks great. The roof looks really good as well. It's got a great foundation, an updated kitchen, but maybe the owner just needs to sell quickly and so has brought the price down so that he can leave. Or maybe the photos just didn't do it justice. That house is undervalued, not because it's broken, but because the market hasn't caught up to it. So these are the kinds of stocks that we're looking for. So in the case of the stock market, they would include stocks that maybe have a price to earnings ratio below 20, have a positive earnings per share growth rate, have a positive free cash flow growth, and revenue that's trending in the right direction. All right, so now that we know what I mean by cheap, let's use AI to cut through all the noise out there. Let's dive in. So here's how I used AI to go from hundreds of stocks to the 3 you're about to see. I started by casting a very wide net. I asked it to show me a list of companies with PE under 20, a price to earnings growth ratio under 2, and had positive free cash flow. And it came up with a lot of companies, as you can see. So these companies look cheap on paper, but cheap doesn't mean we can invest in them. So I tightened the filter a little bit to get us to fewer stocks. I asked the AI several different questions to tighten the filter even more. And different prompts worked better than others. I asked the questions like, show me which of these stocks have outperformed the S&P this year. Which of these companies are in defensive or inflation resistant sectors? Which of these stocks have low debt or have analysts saying you should buy them currently? Show stocks that rise on the days that the market is down. And finally, I asked it for a wild card. Which stock fits all this criteria but might be in an out of favor sector? And that one shocked me. Now, I will tell you, this was a pretty frustrating process for me. There were a lot of stocks on the list that AI provided me that when I checked against some of the metrics that I had set, it turned out that the AI was wrong. It had provided me with stocks that did not fit some of the criteria that I had asked it for. For instance, it told me that Oracle stock was up 4.9% for the year. Well, when I actually look at it, it's down 26% for the year. Or Accenture stock, it said it was up 3.6% for the year, but when you look at it, it's actually down 20% for the year. So this was extremely frustrating to have to go through each stock to figure out which was actually up and which was actually not. So what does this tell us? Well, it seems to suggest that the AI isn't really great when it comes to screening stocks for numerical criteria. But what I found it to be great at is analyzing the stocks that I eventually picked. It gives you quick access to news data, great summaries for that particular stock of its price to earnings multiples, its growth rates, its free cash flows, its earnings reports, and the sentiment around the stock. All right, let's get to the picks, starting with the one that looks solid right out of the gate. So the first stock we've got is Abbott Labs. So what does the company do? It makes medical devices, diagnostics, nutritional products, and pharmaceuticals. We can all see why this would be a good stock to own right now. Whether there's a recession or not, for those who need drugs, that's not going to stop. Nutritional products, we still need to eat whether there's a recession or not. And diagnostics, when you're sick and you need testing done, Abbott Labs provides a lot of the kits that are used in conducting those tests. and medical devices. When you're severely ill and need devices, they make those devices. Let's look at its financial metrics and what makes it attractive from a stock perspective. It's trading at 16 times, below its industry average of 28 times. Free cash flow, 6.35 billion, which grew 25% versus last year. And its adjusted net income of 1.92 billion in this quarter. Let's look at its stock price performance, and for this we'll go to the charts. So year to date, it's up 14% versus the S&P, which is down roughly 11%. In the past year, it's up 21%. In a world in which there could be a downturn, Abbott is a stock with a diversified portfolio of healthcare products. It's also strong financially, and analysts are optimistic about its future. So is it a stock that you would consider buying? Why don't you drop me a comment and let me know? This second stock brought something a little different to the table that I hadn't even thought about. It has to do with gold, but I guess it makes sense. The name of the stock is Angold Ashanti, or AU is its ticker symbol. I guess in a world in which inflation fears abound as a result of the tariffs, it would make sense that a gold stock would be doing well in these market conditions. So what does the company do? So it's a company that mines gold in Africa, the Americas, and Australia. It's the third largest gold producer globally, which would mean it's poised to benefit from the increases in the price of gold. Gold is an asset that is attractive because of how difficult it is to get. And the difficulty in the ability to mine gold results in a higher price. So what are its financial metrics? P ratio around 13, a PEG ratio of between 0.8 and 1.2, positive free cash flow. It's even got a dividend yield, 2.1%. So you can park your money in it for the long term and earn 2.1% in dividend. Gross margin of 36+%. From a stock price perspective, it's gone up a lot this year. So it's up 81% this year versus the S&P, which is down roughly 11% this year. If I were looking at this for my portfolio, I'd be cautious given its recent price run, but given its dividend yield and the sentiment around inflation, it could be a good stock to own during these times. Also, what does sentiment look like around the stock? So analysts have generally rated it a buy. Gold prices are rising amidst inflation fears and tension around the world. It's also held by the big guys, BlackRock, Vanguard, and many others. So we got a stock with the low PE ratio, favorable macro environment right now, and it's in a market where there's high demand. There's high demand for gold in inflationary times. So why does it look undervalued right now? It's got a low PE ratio and great cash flow. We are in a time with a lot of inflationary fears currently, and that boosts the price of gold, which boosts the income of gold miners. And it's trading in an emerging market, which could be a good or a bad thing. It might make sense to own stocks in this environment that are exposed to markets outside of the US, and this one represents that. So what do you think about this one as an option? Why don't you put a comment below? Is this a stock that you'll be buying? All right, so this last stock shocked me. But when I really think about it, I guess I really shouldn't have been that surprised by it. Americans do love to eat, and we do love our fast food. And so this stock popping up on a screen when I asked the AI to provide me with a wildcard option that I might not be thinking about now makes all the sense in the world. And what is the name of the company? It's Yum Brands, ticker symbol YUM. So think KFC, Taco Bell, Pizza Hut, and the Habit Burger Grill, which I've heard is really great. The company also has a big international presence as well, which is a hedge against the US consumer. So what are its key metrics? Its PE ratio is a bit above where we'd like to be for an undervalued stock, but still reasonable at 26 times. Free cash flow of 1.4 billion, and its free cash flow is growing at a faster rate than its earnings per share is growing, which is pretty good. And then from a stock price performance perspective, on a year-to-date basis, it's up 5.2%, while the S&P is down 11%. So that's a 16% delta between the performance of Yum Brands and the S&P 500. The analyst consensus on this one is to hold, but it has a price target above where it currently is today. It's trading at roughly $140 with a price target of $154, which is 10% upside from here. For me, there are lots of things to love about the stock, but the one that I would point to the most in this market condition is its franchise model. So what does that mean? A franchise-run business is typically very capital efficient because there's not a lot of investment in the building out of the stores. That's the responsibility of the small business owners and the franchisees who own the firm. And so this generally leads to predictable cash flows, a stable revenue model for a franchisor. And in these market conditions, if visits to the stores continue to stay consistent, this business will continue to grow. Also, the business continues to grow significantly outside of the US. So what do you think about this one? Is Yum Brands a stock that you would like to see in your portfolio? I know I'll be taking a deeper look at it. Why don't you comment below and let me know what you think about this one? So in the difficult market conditions that we find ourselves, it turns out that there are still some undervalued stocks that we could investigate and add to our portfolios. And AI can be an assistant in helping us evaluate what those opportunities are, put in the information at our fingertips, understanding market sentiment around the stock, key metrics of the businesses, as well as where they could fit within our broader portfolio of stocks. So let me know what you think about this format of videos. If you like it, I'll do several more of them. I know just like you, I'm always looking for opportunities to make additional investments, and I'll be doing the research anyway, so I might as well share it with you. So like and subscribe so I can create more videos, and I'll see you in the next one.